How to build a portfolio. Presented by WallStreetSurvivor.com. Before you build a portfolio, you have to ask yourself two questions. 1. What is your investment horizon? Or in other words, how long do you have to invest? For example, a 25-year-old guy is looking to make some quick cash to buy a new car for next week. That timeline is pretty darn short. On the other hand, if he was saving for retirement, that timeline would be much longer. The second question you have to ask yourself is, what is your risk tolerance, or how much risk are you willing to incur? For example, a risky company would be a biotech company that is awaiting FDA approval for a new drug that could cure cancer. If the approval goes through, the investor could stand to make a fortune. Otherwise, his investment would be worthless. The opposite would be investing in something relatively safe like a utility company. Most of these companies have been around for a while and have shown stable earnings and consistent dividend payout. The investor probably won't make a lot of money, but he probably won't lose much either. You use time horizon and risk tolerance together to create an investment strategy. There are dozens of investment strategies that you can use to build your portfolio. Here's a couple. A diversified portfolio consists of stocks from different industries, sectors, and locations. By not putting all your eggs in one basket, you can reduce your risk. The opposite of diversification is industry-specific investing. That means buying stocks from only one industry. You would use this strategy if you had specific knowledge of the industry, you felt the industry was about to take off, or you felt the industry was the safest bet. Here's Susie. Susie is a freshman at college and needs to choose her classes for the upcoming semester. But how will she decide what course load is best for her? If Susie was undecided about her career path, she would choose classes across different disciplines and faculties. If she discovers her art skills are poor, her other courses will balance out her GPA. This is a lot like diversification. If Susie knew for certain that she wanted to go into accounting, she would fill her course load with only accounting classes. This is a lot like industry-specific investing. Diversification and industry investing are just two of many portfolio strategies. To learn more about them and other strategies like blue chip, penny stocks, speculative, and growth and value investing, check out WallStreetSurvivor.com.
The term technical analysis might sound a little, well, technical, but it's actually pretty simple. Essentially, it's a strategy an investor uses to examine an investment's chart in order to forecast its future performance. Many investors use technical analysis to identify when to enter or exit a stock position. When performing technical analysis, investors can use a variety of techniques and tools to analyze a chart. In this video, we'll focus on a few technical analysis basics, including trend, support and resistance, price patterns, and technical indicators. Let's start with the first technique, trend. Trend is the general direction a stock's price is moving. There are three kinds of trends: up, which is a series of higher highs and higher lows; down, which is a series of lower highs and lower lows; and sideways, which has roughly equal highs and lows. Investors determine a stock's trend by identifying the direction of its highs and lows. Trend is important because many investors believe that a stock will generally continue in the same direction it's been going. These investors would anticipate a stock with a strong uptrend to continue to rise, while one with a strong downtrend will continue to fall. Many investors draw lines to help identify the trend. Investors can also draw lines to connect highs and lows. These lines are known as support and resistance levels, the next technique we'll discuss. Support and resistance are price levels that the stock has had trouble breaking through. If a stock breaks through support or resistance, it could be a signal to enter or exit. For example, suppose a stock breaks through resistance, which is a level it repeatedly pulled back from in the past. Because it broke through resistance, many investors believe that there's a good chance that the stock will continue to rise. So broken resistance may be a good time to enter. On the other hand, if the stock fell past a support area, it may continue to fall. This is usually considered a good time to exit. After connecting support and resistance levels, a stock's price movement may resemble a certain shape. These shapes are called price patterns and are another technical analysis technique. Price patterns can build on support and resistance, allowing investors to predict more specific movements and point out even more precise entry and exit signals. There are many different price patterns. Some examples include simple shapes like triangles or flags, and more complex patterns like head and shoulders or triple tops. Let's look at an example. This is called an ascending triangle, and it forms when a stock's highs are hitting resistance while its lows are steadily rising. Some investors might interpret the narrowing between the highs and lows as a signal that the stock's about to break through resistance. If it does, the stock's price is expected to rise in value right after the breakout. But not all investors exclusively use support and resistance and price patterns. Drawing lines and finding shapes can be subjective. Because of this, many investors also use technical indicators. Technical indicators are graphical representations of chart data. Each indicator displays chart data, like price and volume, in a unique way, giving investors another perspective of the stock's performance. Because technical indicators are created using formulas and data, they give investors a more objective way to examine a stock's performance. One of the most common technical indicators is a moving average line. This indicator averages the stock's price over a period of time and plots it as a line, which can help determine the overall trend. Moving averages can be calculated for any period of time, but one of the most common is 50 days. So what does a moving average tell you about an investment? Imagine a stock's price crosses above its 50-day moving average. This indicates that the stock is outperforming its recent history. This could be an entry signal. Similarly, if the stock begins to fall and dips below its moving average, it could be an exit signal. Moving average lines are only one of many technical indicators you may use. Other common indicators include price envelopes, Bollinger Bands, stochastic oscillators, and the relative strength index. At this point, we've covered some basics of technical analysis. One thing to keep in mind is that technical analysis can help you identify entry and exit signals, but it offers no guarantee of success. After all, there's no way to predict the future. However, many investors use technical analysis to help them put probability on their side. We've only covered the tip of the technical analysis iceberg. Learning how to use the techniques and tools we've discussed, as well as the many others out there, can advance your technical analysis skills. Take control of your financial future today with premier education brought to you by InvestTools.